right. Hey everyone. Good evening. Keshav here with Clive Capital. I have my partner here, John Lay. Lay or Lie?
Everyone, line. It's line.
Lie every time. John Lie. Sorry about that. And we have today with us Ryland Moore. Ryland, I met through a mutual connection of mine, and today he's going to talk to us about investing in water. So, Ryland, I'm going to let you take it away.
Great. Thanks, everyone. As Keishav said, my name is Ryland Moore, and I am a principal at an investment firm based in Portland, Oregon, and then also hold my real estate license with a ranch brokerage firm that's out of Jackson, Wyoming. And my background is a little unique. It's more around uh, ranch and farmland assets, and as well as dealing specifically with water and water rights in particular. I've worked both on the nonprofit side and in directly investing in water through private capital on behalf of investors and municipalities, energy companies, and the like. And so today, what I would like to talk about is, what are water rights? How do you invest in something so obscure? And maybe give you all your audience a little bit more information about, the water world and how do you invest in what we call wet water. So different than pumps and pipes, like you'd hear, like in a municipal supply or investing in delivery systems or water technologies. This is actual real estate, which water rights are private property interests. So I'm going to share my screen. We'll start
So,
with
I
the
guess we'll finally answer
presentation.
that age-old question: Is water wet?
Yeah, exactly. Yeah, let me go to this and slideshow. Can everybody see the screen?
Yep.
Okay, great. So most people know about the water cycle, but I'll just briefly kind of go over it. So, today there is no more water on the face of this earth than there was millions of years ago. Same amount of water. It's just what state is that water in? Is it locked up in ice? Is it in some kind of water vapor? Or is it actual, salt water, the oceans or rivers or streams or underground aquifers? But in essence, the world just recycles this water over and over again. We may not have as much available to us today based on cleanliness or pollution or what have you. And most of the water on the face of the earth is locked up in the oceans. So how do you get it something like that from an asset standpoint? And it's definitely geographic too. I mean, when you think about different parts of our country where we live, here in Portland, especially today, it's pretty wet. But you can go down to Southern California, you can go down to the Southwest, the arid Southwest, and it's pretty dry down there. And so geographically, where people live, also, and the demand of that of water affects price. It affects the availability of it. It affects where it comes from, and it runs across all sectors: private, public, with government issues. And so nobody's immune. And the one thing about water is we all need it to live, unlike other assets or other commodities. And I'm using that term commodity carefully with water because a lot of people think that's a terrible word to treat water as a commodity. So water is finite. Only 2.5% of all the water on Earth is fresh. And of that, the majority of that, almost 100%, almost 99% of that is locked in ice or in deep underground aquifers that we can't access or that aren't economically viable to access. Yet we need it to sustain all life on Earth. Different than oil, for example, where we can get away from that. As population continues to exponentially grow globally, and as you have issues with climate change, depending on what side of the fence you are around climate change, we are seeing a significant increase in the scarcity of water from a global perspective. Mass droughts that are lasting not just 1 year or 2 years or 3 years, but we're going into decades in some places throughout North Africa, Sub-Saharan Africa, Australia, and even where we are in the southwest of the United States, Texas, and Mexico. So another big issue, and the reason water is so important is because it does sustain all life on Earth. And of all the deadly diseases that are out there, waterborne diseases kill more people than anything else in the entire world. That's just not having access to clean, potable drinking water. Mostly, you see that primarily in throughout Africa, and there's a technological standpoint there. There's also factors in resources and being able to get at water, but it still continues to be a major problem throughout the region, even in developing countries, large developing countries, where we still see, developing middle classes, growing middle classes, still have problems with access to clean, potable drinking water and are having significant amount of deaths still attributed to lack of clean drinking water. So here in the United States, when you start thinking about some of this stuff, when you look at, sorry, I shouldn't have gone there. So this was the Water Supply Sustainability Risk Index that was developed of where by 2050, if you think about no climate change. So that's not a factor at all. This is what we're looking at from a stressed area in 2050. And so you can see throughout the Western United States, especially parts of Texas and even down into Florida. But if you shift that to factoring in climate change and where temperatures are going and population demands are going, this is what it would look like with climate change being factored into that. So it's a pretty real situation. These are models that are updated on a regular basis, but it still puts into perspective everything going on and how something like this, and this isn't just for what I'm talking about today with water, but if you start to think about where major population centers are and where people are moving to, and if you're investing in real estate, where's that next growth place going to be? So part of what's happening, it's happening now, and we're going to see more of this, is outmigration and migration into new areas to where basic resources are available. And so the world is dealing with this now, mostly in more developing countries, but we are going to continue to see this as climate change continues to cause problems, as natural disasters continue to occur more frequently, and as water becomes more scarce and potentially more expensive. Right now, we don't pay for the value of water through a municipal supply in any way. So if we start to factor what the real cost of water is, that could have a significant change in migration patterns and where people decide to live and reside, and what they're willing to deal with from an environmental standpoint. So when we look at where water is taken and what consumes the most water, and some of this isn't what we would call all consumptive. Some of it evaporates, some of it is just passed through. But you look at the red and the green in particular in this chart. And so you have thermoelectric power and irrigation are the two largest users of water in the United States. And 32% is significant from an irrigation standpoint. That's primarily what we're going to be talking about today. But thermoelectric power is also another one. Geothermal technologies are really ramping up, and I think we'll continue to see more opportunities for that from a renewable energy standpoint. But by far and large, you look at the amount of water that is consumed compared to things like your public supply or domestic supply of water, which is only 12% of the entire U.S. freshwater usage. I'm going to pivot here and talk a little bit about what's going on in the Western United States. Many of you have probably heard about what's going on with Lake Mead and Lake Powell, and those are major water supply systems to places like California, Las Vegas, Phoenix, coming out, and it's all coming out of the Colorado River. So if you go back on the vertical axis there, you're looking at what's called millions of acre feet. And an acre foot is a measurement or a measurement of a unit of water. So it's roughly 316,000 gallons is 1 acre foot. It's 1 acre of land covered 1 foot deep. And so when they distribute water from an irrigation standpoint or an agricultural standpoint, it's all based on a quantity of acre feet. The average acre of alfalfa, let's say here in Oregon, uh, they usually allow for 4 acre feet per acre per year. So that's what it takes. And out of that, you'll have some loss to evaporation depending on the efficiency of your irrigation system. The crop will consume roughly 2.6 acre feet of that 4 acre feet. So you divert 4 acre feet from the river, or pump it up from an aquifer, spread that across your acre of land, and then that water is then used to grow that crop. But when you think about that amount of water, an acre foot of water is enough to probably provide drinking water and household usage and a little bit of irrigation around your home. 1 acre foot of water could probably supply maybe anywhere from 4 to 6 houses. So when you think about 1 acre of water rights versus the consumption of water, you can really do a lot more with that than just irrigate an acre of alfalfa, which won't produce a whole lot. But the purpose of this, and what's going on here with the inflows coming into Lake Powell compared to the outflows, is a significant drop in what's going on in the storage systems and the sources of the water that we have. So looking at Lake Mead and Lake Powell here, and you can see what's happening, with all the headlines that are going on. Just a little over 20 years ago, you were almost at full storage of both those lakes. Not quite full storage, but close to it. Compared to today, you're down to maybe 25% storage at most, and no end in sight either. Which is and also you have significant population growth throughout Southern California, Nevada, and Arizona. So what's happened now is that the supply cannot keep pace with demand. And this creates some real problems. And what do you do when that supply and demand go inverse? And you're no longer able to meet that supply. There's only a few ways you can solve it. You can try to conserve water. You can find more efficient ways to deliver water. You can provide less water from a demand perspective, or you can start charging more money for that water, and it'll weed itself out there too. So basic principles of supply and demand, and that's what we're dealing with. The problem was when all these water rights were issued, it was during a fairly wet period during our climactic cycle. And so therefore you're dealing with a situation now that they issued more water rights than there is water available. And then when you throw drought on top of that, then you're just in really big trouble. So when you start thinking about investments in water, like I talked about earlier, there's wet water. You can do pumps and pipes. From a delivery system perspective, there's innovation in water technologies. We've invested in a really cool company that does this, where it creates water from passive solar. They're based out of Arizona, of all places, down in the desert in Tempe. But there are a whole bunch of other ways to do it, whether it's sanitation being financed through government projects, public-private partnerships, NGOs that are doing projects in locations. But what I'm going to be talking about in particular is really about how to invest in agricultural land that has irrigation. What are some of the risks associated with that? And how do you start to even understand this when you're looking at an investment opportunity? So we already talked about that panel group I was telling you about, that water technology group there up in the top left. Pumps and pipes are a great way to invest if you're investing anywhere from municipal bonds. It's not going to give you a great return, but it's pretty stable. Um, you can invest, there's mutual funds out there. There's publicly traded companies that deal with water that you can invest in as well. But what we're talking about is in particular is farmland here. And how do you invest in water through agriculture? So one of the big things about when you're looking at water is it's not well known. So there's I think a large opportunity to really um, invest in this space without because it's not so well known yet. I think there's a huge opportunity to invest, mostly because of it's not the water asset itself is undervalued, especially when you're talking about farmland. Um, 1 acre foot of water as it relates to an acre of farmland is really, really inexpensive compared to that same 1 acre foot. If you're going to sell it to a municipality, or you're going to sell it to another private buyer who's a developer, for example, or somebody in the energy space. Um, we've already talked about the supply and demand imbalance that we're seeing, and the amount of capital that needs to go into all sorts of things, whether it's infrastructure, sourcing, delivery methodologies. All those are really they're starting to be taken into account in certain areas, but it's a reactive mentality rather than a proactive mentality. Um, and then for those that care about impact, and really want to invest with their values, that's another component of what we're talking about. So we talked about the replacing and expanding your infrastructure. That's where most water losses come from. In the wastewater municipal treatment systems, you've heard about seawater and desalination, extremely energy intensive and inefficient. Um, and so other ways that you can actually save water or create water or use it more efficiently is more in the agricultural space, whether it's a storage component system or you're increasing very inefficient irrigation systems from flood irrigation, which operates at about a 50% efficiency, to what we would call drop tine sprinkler systems or direct injection systems, which can get you up to 85 or 90% efficiency. Very little loss of water that goes out. And each state will allow you to keep that water that you can serve, to use it somewhere else on your ground. Some of the other short investment targets are more around what we would call things that are going around, you know, dealing with natural disasters. What are some of the risks that you're dealing with? I'd say one of the biggest issues that you do have with this whole system is that the government does have some form of control, just like a local government would have zoning regulations on what you could do when you invest in a piece of real estate. You have zoning requirements and easements that are allowed on your property, and delivery systems and electricity systems, and the each state technically owns the actual water. All water in each state is owned by that state. So they give you the right to use that water through issuing water rights, and they have restrictions on what you can use that water for, seasons of use, quantity that you can divert. But for the most part, you have control of the water. You just don't own the actual water. You just own the rights. So one of the biggest problems with water is that it's heavy. It's really inefficient to move it long distances, unless you have a natural river and take advantage of something like that. But let's say that you wanted to deliver water, even if you could, which you can't right now, to deliver water down to the Central Valley of California from up here. It wouldn't make a whole lot of sense to do that. And so, Michael Burry, who was famous, he's run some hedge funds called Scion Capital. Um, but Michael Burry, that was in The Big Short, where he predicted uh, the whole real estate bust in 0809, he started looking at water as well as a way to do that. And the way he's looking at that is uh, dealing with it through the food mechanisms. And the way I translate that is agricultural farmland. You could also invest in food because water is takes a lot of water to grow food, whether you're talking about crops and staples or you're talking about um, beef or anything else. Chicken. It's amazing how much water it takes to grow one cow or one chicken. So the definition of a water right is, and I'll just read this, it's a legal authorization to the beneficial use for a reasonable quantity of public water during a certain period of time that occurs at a certain place. So the beneficial use is really critical, which means each water rights certificate says what that use is allowed for. So if it's for irrigation, it'll say you can use this for irrigation, and you can use it based on what they call a rate, or the how much water, how fast it's going, and also a duty. The duty is the acre foot or the quantity amount. And then what season of use you can use that for. So a lot of water rights that are irrigation will say you can divert X number of acre feet at this rate between March 15th and October 15th of every year. And as long as you continue to do that, then your water rights are protected and you can continue to use that. So Western water law, which was, kind of came out of different than what we would call riparian water law, which is more East Coast. Western water law was born on a premise of first in time, first in right. So this is called the law of prior appropriation. So Keshav, if you came into this area and you bought a farm or you developed a farm and that was in 1895 and you started diverting water to irrigate your 100 acres. And then John, you came in 2 years later and you bought 100 acres right next door to Keshav and you started irrigating your own 100 acres. As long as there's enough water for both of your farms, then you have no problem irrigating. But as soon as let's say the stream that you were pulling the water from dropped below a certain threshold where only one of you could irrigate, then Keshav gets his water before you get yours because he was there first. And that's the law of prior.
That's a great way.
So, like I said earlier, all water within each state is governed and owned by that state. New uses of water require a permit. So anytime you pull water from either the surface or the ground, you need a water right. There's a few exemptions in there, mostly in rural communities. Each state has what are called exempt well statutes for the most part, as long as there's no significant limitations around that groundwater in that basin. But for the most part, you don't need a water right for that. That's just what's called an exempt use. Other things that are exempt uses are things like stock watering. You can water as many cows or chickens or whatever you want without a water right. Fire suppression is another one. You don't need a permit if you to put out a fire on your property. But everything else you do. Water rights that are ahead of yours are protected. So if in most cases, they aren't issuing any more new water rights, at least from a consumptive standpoint. So something to keep in mind. Water rights are pertinent to the land. So whatever the place of use, there's always a point of diversion or point of withdrawal, depending on surface or groundwater. And then there's always a place of use. So where can you use that? When can you use that? The quantity you can use that is all dictated by that water right. And then to change that, if you wanted to change it even to other acres on your ground, you have to submit an application to the state to move that water. Surface water rights are usually superior to groundwater rights. The reason for that, though, is not based on the supply. Actually, groundwater is probably more reliable in most places than surface water. But the difference is surface water is older. Pumps didn't exist back in the 1800s. And so the most senior water rights are surface water rights. And what we're seeing in the world of water is that right now in most places, not all, but in most places, surface water and groundwater are managed separately. But in a lot of places, especially in arid lands, what they're starting to better understand, they're still learning about this, is that groundwater and surface water can be connected. And therefore, if you're pulling water out of a river or lake system, you could be impacting the groundwater system in that area too. Same thing, if you're pumping out of the ground, you could be impacting the surface water, depending on what's going on in that stream and the hydrogeomorphology of that stream. And so, what I believe and what a lot of attorneys believe is that um, the states will start to regulate groundwater and surface water together, and therefore it'll still be based on the law of prior appropriation. So whoever has the most senior water gets their water rights first. The final thing about water, which is pretty interesting, and each state a little bit different on this, is use it or lose it. And not just use it to, if you have 100 acres, going back to Keshav's 100 acres, if you have 100 acres of water, of land to irrigate, and for some reason, Keshav's like, I don't want to irrigate 100 acres. I only want to irrigate 10 acres. And he only irrigates those same 10 acres. And he does that for a period in Oregon. If he does that for a period of five consecutive years, then he no longer has a water right for 100 acres. He just has a water right for 10. Now, there's ways around that. If, let's say Keshav decided he was going to irrigate 20 acres, but he only is out of his 100 acres, but he irrigated those each 20 acre section that was different every 5 years. The whole water right would still be valid because he's using it as long as he's pumping the same amount and spreading that water around. He's still using the same quantity. And then for today, they're private property interests. So it's like timber rights or development rights or anything else. These can be bifurcated, separated away from your property, the actual fee title or your fee title interest of the property, and you can sell these. So they have a significant value. And then finally, you can't create a right through illegal use. So you can't just say, I'm going to divert the water right or divert the water. And since I'm using it, it's not like a squatter's rights where if you stay on there long enough that you just all of a sudden it's yours. It's an illegal use of water, and therefore it's not yours. The water is owned by the state still.
When you say, quick question, Ryland, when you say Western water law on the previous slide, do you mean like Western US or do you mean like the Western Hemisphere?
Yeah, good question. Western United States. So, versus, when you start getting into the Midwest, pretty much west of the Rockies is where you see this. Sometimes it creeps into Nebraska. Texas has its own kind of system. So it really depends on geographic location where you are. And riparian law is more based around, at least with surface water, you have to live on that river. Your property has to be adjacent to that piece of water. Whereas, if you look at all the water that's diverted out of Colorado, that's going hundreds and hundreds and hundreds of miles away from the actual riparian zone of that river, or what's left of the Colorado. So when we look at farmland values, pretty steady increase, over the last, 14, 15 years in farmland value. Now, this is, average prices across the entire United States. And so when we start thinking about some of these prices, geographically, it becomes significantly different. So then you start breaking it down to cropland values over that same period of time. And what you're also not seeing in here, though, is the demand for water that's going up, but cropland values aren't significantly increasing. Yeah, they've doubled almost in that period of time, but that's not a huge number from a return on investment. And so when I talk about water not being factored into the value on a price per acre basis because it's farmland, water, yeah, it's important, but it doesn't significantly change compared to what that water is worth if you start looking at it from what we would call it's the wrong term, but it's like a higher and better use or more meaningful use for that water.
Hey, Ryland.
Yes.
A quick question. How do you, you hear from farmers that, they can't turn a profit Um,
Mhm.
because with farmland, how do you reconcile that with the increase in the farmland value?
Yeah, well, and that part of that is it's really interesting. So, I mean, the way and it depends on what you're growing. I mean, a lot of the farmers I've worked with in the past, they're able to make a profit. They just take it all and throw all the money back in, so they don't show any gains back into the farm. So, yeah, if you want to, you can make a profit, even paying some pretty high multiples. Um, I'm dealing with a transaction right now that it's generating about $600,000 of cash flow off the farm on a $8.3 million purchase price per year. So not a bad, um, uh, ROI when you're starting to look at that perspective. But they're taking that 600K and they're buying new equipment. They're putting it back into the farm. They're improving the systems, the irrigation systems. Just so they don't show a profit, but there's definitely cash flow there. Um, the other thing that people that aren't farmers that don't want to farm, they'll do one of two things. They'll either lease the land out, and there's all sorts of different ways you can do it. You can do it 2/3, 1/3 cost share on the revenue side, where 2/3 goes to the landowner, 1/3 goes to the tenant farmer. You can hire a farm manager to manage it if it's enough acreage, and you find the right property that's a really uh, good irrigation farm. And you can also do a whole bunch of other things like sublet that farmland out to other things. This one farm in particular has about 100 of that 600K coming in, is coming in off of their like leasing the ground out for a bull operation. They don't have any knowledge of bull breeding and auctions, but that's what they pay them to use their facilities. So you can get pretty creative with crops. There's a big push here in the Northwest for everybody moving to hemp, and that didn't work out so well for most people. But um, I think just being really steady, finding ground that's not outrageously expensive on a price per acre basis, but that is good soils and really senior water rights is something that's a really, I think, a lucrative opportunity. Um, so in the southwestern United States, what's interesting is that it's an area where there's a lot of drought, significant drought, but the price for that water, hasn't really gone up in a significant uh, um, overall hasn't gone up significantly, except for in places like the Front Range of Colorado, and maybe some other spots. But right now, you see some stuff down in Yuma that's pretty expensive. But overall, when you start looking at what the price is for other areas, it's not outrageous, and I think that's a pretty unusual situation. Doesn't make sense, is what I guess is what I'm saying. So let's look at an example here real quick. So back to the 100-acre farm, senior water rights, 4 acre-feet per acre, using flood irrigation, valued at $6,000 per acre. Okay, so that farmland is $6,000 an acre. That you buy 100 acres, um, and then you upgrade the irrigation efficiency. There's all sorts of federal programs, state programs, local programs to help you with this cost. So you can then upgrade it to more of a center pivot system that would allow you to save up to 50% of that water, just based on the efficiencies of the delivery method alone. So now instead of with that, 100-acre farm at 400 acre feet, you've now saved an extra 200 acre feet of water that's being conserved through your upgraded system. So what do you do with that? Well, you can sell it off. Certain areas are starting to create markets for it. You can sell it to another farmer. You can sell it to municipalities as long as you're in the same body of public groundwater or surface water. You can sell it to conservation organizations. You can sell it to utilities. They really need a lot of water. And so, in a very simplified way, that can create some pretty significant revenue. And you haven't done anything to the farmland. You're still irrigating the same 100 acres. You're still producing. And just through this irrigation efficiency system, you've been able to create some pretty significant short-term capital. some of the other additional benefits that you get from water, you're treating it like any other real estate investment. So you're still looking at depreciation costs. You can do it on farm equipment and any improvements you have. You've got fertilizer, seed, equipment, fuel, pumping, vehicle costs that are all deducted. You run it just like you would a business. Same thing you do with, a multifamily complex that you purchased. Um, some other tax benefits. I'm not a CPA or an attorney, just FYI. But if there's any financing, you can still write that off. You can donate or sell conservation easements, saying I'm going to keep it in farmland rather than convert it to a bunch of houses or subdivision or something. There's a whole bunch of other federal programs you can participate in that generate revenue for you. Um, One of the biggest ones is tax abatement on farmland compared to regular. I mean, on that $8.3 million property I was using as an example, the entire property taxes across 1,200 acres is roughly $8,000 a year. And that's because it's staying in farmland. And your asset can be protected just like you have fire protection or flood protection insurance. You can get crop protection. So if something doesn't happen that year, then you're still getting paid. And then even the cash land rent from a tenant is also deducted. So all the while, you're still producing income from the crop that you're actually growing every single year. And you get some appreciation of the actual underlying real estate as well. So some of the ways that I look at, what's your IRRs and some of these things, if you can get greater than 20% IRR across the board, that's pretty impressive. Especially when we're talking about cap rates these days of like 3 or 4%. Maybe that's going to change here soon. But, if you can get that kind of IRR, that's a true, that's a real estate, I guess, darling to me if you can get that on a consistent basis. That's even good in private equity, depending on how long your investments are going. I feel like the IRRs always get crammed down the longer they're sitting out there from the ones that are, and if you're investing in a fund, let's say, it just starts to go down over time. You might have some good home runs initially. So when I think about something like that, and that's not guaranteed, but at the same time, there's a lot of different ways to deal with it while also protecting yourself on the downside. Now, this isn't without risk. And so when I start thinking of these things, when I think about risk itself, what are some of the risks that could happen? Well, you might not be able to monetize the water rights. Maybe you buy in an area that the water rights are there's nobody within that public groundwater area or downriver from you with the river system that you're investing in that you could actually sell the water to, or there's just no buyers out there. You still have the underlying farmland investment. So that's good. But if you really wanted to hit a home run, it's fine. It's trying to line up the geographic location with the senior water rights that have been beneficially used. And then also having a potential off-taker sometime in the future. So those are some things to think about. The other thing that you can't rule out, and you could never rule this out with any real estate investment, is eminent domain. And so I worked on a deal many years ago where there was a gentleman who bought an old brewery up in Olympia, Washington, and it had significant water rights. But the gentleman was going bankrupt. And because he was a private holder of that water, he was trying to convert it into a water bottling facility. Because he was a private holder of those water rights, and he was going through bankruptcy, he was running against the risk of the use it or lose it statute of not using that water for 5 years. And so when these states issued these water rights, they issued more water than there was water available. And so if you actually do allow a water right to fall back into forfeiture, it's not like it goes back into a pool that can be used by somebody else. It's gone forever. And so the city of Olympia, we actually helped them use their power of eminent domain, and we actually the city assumed those water rights from this private owner. So that is a risk as well with anybody. It doesn't matter if you're irrigator, farmland's an easy target because of the quantity of water is so significant compared to the economic output, compared to that same quantity of water that's for municipal supply, the public good. Um, the farming industry has really strong lobbying powers at the federal level. So it would be a pretty big deal for that to happen, but it's not unfathomable. They could do that if they wanted to. Just like they could take your property to build a highway or widen the road or do something like that. So that's all I've got. I mean, you do want to go in these things eyes wide open. You would want to have somebody that understands water law. So you'd want to talk to a water rights attorney if you were looking at some farmland. And always, when you're looking at farmland, you'd want the seller to provide what's called proof of beneficial use over that period of time, depending on what state you're in. So in Oregon, no period of 5 years over the last 15. If you're in Washington, no period of 5 years ever. They'll look back since the inception of the water rights. And it's amazing what you can learn just from looking at aerial photographs and does it look like it's irrigated. There's ways to actually back calculate off of power records and anything that was produced off the land. So you do want to go in eyes wide open when you're looking at these things. Don't just assume that if somebody's selling you an irrigated farm that it actually has been irrigated continuously. And I will pause there.
That was a lot of information, Ryland, and I appreciate
Sorry.
it. No, it's a good thing. It's a good thing. I'm sure everyone learned a lot. I don't. Everyone knows. A good amount of people, I would say, know how to invest in real estate. I think water is a much more niche asset, and that's what excites me about our conversation today. So we'll give it a minute or two, see if anyone has questions. If not, I have a billion questions. I'm sure John has a billion questions. So we'll just wait here to see if others have questions first and go from there.
Okay. All right. If we're going to go into questions, I can stop sharing if you'd like me to, and let's go straight into dialogue. Does that sound
Yeah,
good? Unless you
yeah,
want me to refer back to any of the slides at all.
that might help. And then obviously your contact information is helpful to have up on screen for a bit too.
Okay. All right.
How did you, I mean, while we wait for any questions, like how did you find out about investing in water? Like how did you get into it?
I fell into it more than anything else. I was working for a nonprofit where I was buying and selling water rights from farmers and ranchers, mostly for mitigation through the Bonneville Power Administration, putting water back in stream. So there was some environmental, I guess, issues that were going on. It was going on in the Klamath Basin, but we were working on it in some other basins where the farmers and ranchers could legally take all the water out of the entire river, so it was completely dry. Um, the problem with that, though, is there's also endangered species called Chinook salmon that were using that river to swim up to spawn in their native spawning grounds. And so when they were taking all the water out, they were trapping in endangered species and killing them without what's called an incidental take permit. And we're under Endangered Species Act violations, which that's when the state police show up and start locking head gates. So we started to work with those farmers and ranchers and compensate them for lost crop revenue if they left some of their water rights in stream as in-stream flow, which is a legal beneficial use if you go through the state, each state to do that. While I was doing that, a private equity group wanted somebody that they could bring on who was investing in water throughout the Central Valley of California and the southwestern United States. So they brought me on to, in essence, just go negotiate and buy as much water as I could. That's what I did. There were some problems I had with it because what we were doing is we weren't buying the farmland necessarily. That is a way to do it. We were actually buying the water rights from the farmers directly in specific geographic locations, and then just selling the water. So the farmer kept the land. They were just selling off the water rights themselves.
That's pretty cool. So
Yeah.
we do have a question here from Sebastian. He's asking, what's been your most challenging investment regarding senior water rights?
Oh, well, I think I don't know. So it depends on what you look at as challenging. So for me, the way I was looking at it was um, really the off taker, the selling and bifurcating the water away from the farmland. That's not easy to do. Number one, because it has to be in the same body of public groundwater or surface water wherever you're moving that water from point A to point B. So, for example, if I had a farm in Oregon on a river, let's say it's on the Willamette River, and I had water rights there, and I wanted to sell it to somebody down in Southern Oregon, I couldn't do it. Couldn't transfer that water right because it wouldn't work. But if I was selling it to somebody in Portland downstream of me, then yeah, that you can do it that way. So sometimes you have to get pretty creative on how water moves and really understanding the underlying aquifers and how they've been mapped and everything else. We were buying some water rights out in Eastern Washington for a developer one time. And it was across state lines, same body of public groundwater, but across state lines, which again, each water is owned by each individual state, even though geographically it's the same water. Like
Yeah.
it's the one molecule test, it's the same water, same depth, same aquifer. It just happens to be a state line running down the middle of that aquifer. And so therefore trying to transfer water from point A to point B can be really challenging. So when you're looking at farmland or farmland investing, look upstream of major areas or municipalities. Look for areas that where water could be considered stressed, and then make sure you're looking at actual farms. It's farmland that's been used significantly. The other thing is make sure you talk to a bunch of attorneys to understand what's going on in that basin. The organization that governs the water is the whatever the state's water resources department is. So you want to talk to what's called a water master, and the water master is the person in that particular geographic area, that basin, that's responsible for managing the water assets of the state. But they know a lot of information on a very much more localized region, and therefore they are ones you definitely want to talk to better understand what's going on. Is there any issues with, so for example, what priority date are they regulating back to today? What's the earliest, the most senior water right they've ever had to regulate against? And then making sure you're only looking at water rights that have priority dates that are older or more senior to whatever they're regulating.
Okay. So yeah, some of that makes sense. Not gonna lie to you, but we did part two here at some point. Um, so we'll still open to questions anytime, but we'll just keep shooting them your way. One question that I had that comes off the top of my head is like 20% IRR sounds great all day long. How risky would you say investing in farmlands is compared to, multifamily value add investments?
I think the way I would consider it is a diversifier. So if you're in, let's say that you like to invest in one city, I'd say that's pretty risky to me. I mean, if you're in one geographic location, you're susceptible to a whole host of different things rather than spreading out your investments. It's kind of like your investment portfolio on your publicly traded securities. If you work for a private company and you get a ton of stock options or RSUs coming in, on an annual basis, and to the point where your net worth is 90% tied to one individual security, that's pretty risky. But if you're able to exercise those options and then diversify away from that into large cap, mid cap, small cap, domestic, international, private real estate, private equity, hedge, then you have a diversified portfolio it's not always going to work for you all the time. Mm-hmm. And so that's what I think about farmland. A lot of people look at farmland as a hedge against inflation, because commodity prices go up. And so they're like, well, that's a good time to invest, especially if you can time it where the price per acre is down before that happens. And it's also when you have inflation, that's when the stock market performs. So when you start thinking about those things, about diversification and what's working, nothing's going to work all the time, every time, over long periods of time. We're not talking about 1 or 2 year snapshots here. We're talking about 10 plus years. So that's how I look at it. You have the underlying protection of the real estate over time is likely to go up. You have this water asset that if you buy appropriately, you have a senior water right that is pretty valuable, even not as valuable associated to the farmland itself. But if you're able to monetize that from a higher use perspective, it has significant value. And then you're still getting the cash flow coming off of it, not your traditional cash flow through rents, but cash flow, unless you're leasing out the farm to a tenant farmer, but you get cash flow coming in off the production of what's going on the ground itself.
Are there like private option contracts on on water rights?
That's a really good question. I think that it's starting to get there. You're starting to see, like, for example, there's a water markets group down in based out of Phoenix. There's a really established water market in Colorado on the Front Range where they're buying shares and they're interchanging, going back and forth in and out. Now you have to have the land to put it on. You have to be in that geographic area because it's still tied to where that water right is being sourced. But yes, I think the technology, or I guess the sophistication of how water is being managed is improving on an annual basis. So they're going to come up with all sorts of ways using private markets primarily to be able to exchange water, whether you're looking at options or what have you. I think people are going to come up with so many creative ways here in the next 10 to 20 years. They're going to have to, because they have to find a way to do more with less, spread that water around. But again, the way when I look at water, it's again basic supply and demand. Water is finite, not creating any more of it. So technology is going to help. Efficiencies are going to help. But again, it's a fixed amount. It's kind of like, well, probably a bad example to use with crypto, but when you start thinking about Bitcoin, they're not creating any more of it. It's a finite amount. And so how do you take that asset and monetize it, whether through efficiency, through technology, but with the underlying abilities to still generate revenue without doing any of that?
Go ahead, Keyshawn.
Thanks, John. What do the depreciation benefits look like as far as a typical range of how much, like what percent of your investment you can deduct?
So this is where it gets really dependent, because there's so many different avenues on the farm that you can deduct. And a lot of it depends on how sophisticated your operation is and how much you have going on with the equipment and everything else. So for me, when I look at farmland, I'm looking for something super simple, super clean. I don't want houses on it. I don't want a ton of improvements on it necessarily, unless I need a house for a tenant farmer or somebody that's going to, be the farm manager. But for the most part, I'm looking at, the depreciation's nice. But what's more important is the underlying farm itself is sustainable and can actually stand on its own 2 feet. So, and the other thing is just the cost. So if you're building in your investment and you have some giant home on the property, in a very rural setting, you're probably not going to get as much return on that. Yeah, it's a nice thing to depreciate, but it's not contributing directly to the farm. So from my perspective, and this is just my own personal opinion, I'm going to be looking for something that has very little improvements, but has really good soils.
Sure. Yeah. I wanted to ask, you mentioned that it was an excellent asset class for high net worth individuals. Where is that, that tipping point? Is it $5 million or so?
Yeah.
Where it's viable?
Yeah, good question. So you're starting to see, this is where the SEC steps in and FINRA, and they regulate investment vehicles. And so the IRS codes, there's one called a 3C1 and there's one called a 3C7. 3C7 says that you can only invest in this particular vehicle if you have, as an individual, have more than $5 million in investable assets. 3C1 says you can only invest in this vehicle if you have more than $1 million in investable assets, or if your income 2 out of the last 3 years is over $250,000 gross. And it doesn't include your primary residence as an investment. So there's restrictions on some of these things, and so those are called, you can be what's called an accredited investor, that's the 3C1, the lower threshold, accredited investor, or a qualified purchaser, which is the higher threshold, the $5 million for an individual. Entities are created differently, so if you have a trust, the trust is considered an entity and the threshold is even higher. An accredited trust or accredited entity has to be $5 million in investable assets, or a qualified purchaser for an entity is $25 million in investable assets. But what we're starting, I think the government and the regulators in particular are recognizing is there are people out there, and I'm sure some of you qualify in this bucket, where you know way more than a qualified purchaser just because they have a number. Maybe they inherited $25 million from their grandfather, and but don't know a single thing about investing. And then you have somebody that doesn't make $250,000 a year and eats, sleeps, and breathes structures of private equity and hedge funds and private real estate, and really knows their stuff, maybe has their CFA or CAIA designation, and therefore knows way more and is more. And the whole reason these regulations are set up is to protect people from themselves from getting into something, and them not being quote unquote sophisticated investors. Well, what's a sophisticated investor? Is it just based on the dollars that you have? And so what you're going to probably be looking for is a fund structure that allows for this. You're starting to see, though, more and more fund opportunities to get into these private placements with less and less restrictions. So be looking for, accredited investor opportunities. The one problem with the accredited investor opportunity, and the reason you don't see a ton of these, or they have really high minimums, investments, is because a 3C1 only allows for 99 investor slots, whereas a 3C7 you can have unlimited. And so some funds will do both. So you might have a fund that's a 3C1 and a 3C7 just so they can get their ultra affluent clients into the 3C7, the higher threshold one, and then put their smaller accredited investors in the 3C1. But they still only have 99 slots. So the minimums, when you start thinking about a fund structure and how a fund manager makes money on a management fee, and then having a success fee on the back end, they are going to a 99 slot fund. You need to have millions and millions of dollars in there. And so if everybody's only putting in $100,000, you're not going to be buying a lot of assets with that amount of money. Plus, it's a small management fee. At a 2% management fee on, $10 million is not enough to keep the lights on for if you want to have a really rock star team. So you're starting to see more and more different structures coming out. That's a great question. Not one that's easily solved, but just kind of keep your eyes open for that. That's what you're looking for, is accredited investors versus a qualified purchaser, and who could participate. And then also what the minimums are for those funds. Sometimes it's 100,000, sometimes it's 250,000. Sometimes it's higher.
Do you as a follow-up, or does an investor work directly through an RIA to access those private placements, or if it's public, I suppose you can go to the open market?
Yeah, exactly. So yeah, if an RIA has a relationship with those types of investments, or does those types of investments, what's beneficial about working with an RIA, even though you can't get around the 3C7 or 3C1 structure, the true benefit is that typically those RIAs can go to that manager and say, I see that you've got this fund open, and your minimum is $1 million, which we see a lot of times, $500,000, $1 million minimums. And we'll say, well, we're going to bring you with our client base, we're going to bring you $20 million. So we want the minimums to be $100,000 or $250,000 minimums. And so you get to bring that minimum price down, and more of your clients can participate in that fund. So we do that all the time. We've done that with hedge funds. We do that with private equity. We do that with private real estate. So it helps get around that minimum, if the RA has a good relationship, because they have purchasing power. And it makes it really easy on the manager, because they want to be out sourcing deals. They don't want to be raising funds. So it's kind of like an entrepreneur that's out trying to raise capital for their next round, when they should be just working on their business.
Right. What type of returns are we looking at in terms of either private placements, or you said mutual funds might be more muted?
Yeah. Well, I mean, it's interesting. Like, when you're going to invest in something that's unique, I kind of look at what it is from an opportunity cost perspective. And so I'm going to always be looking at what's my public market equivalent, because when I look at risk, it doesn't matter if it's real estate or anything else, but when I look at risk, I look at the liquidity and not having access to my capital, right? So when you invest in real estate, typically, now you're starting to see more what are called interval funds, where they're mixing public and private. There's actually one here in Portland called Morrison Street Capital that does a mezzanine debt real estate fund, not associated with farmland or anything like that. But they're coming out with an interval fund where you can get into it at any point in time, and you can get out on it. It has quarterly liquidity. So you're starting to see more and more investors want that kind of structure, and they might sacrifice a little bit of return because they can have the liquidity parameters, instead of having to be locked up for 10 plus years in a fund that they can't get out of, and keep paying fees, even when there's these tails of a few companies or a few real estate holdings sitting in these funds. And so when you think about, return, what is your public market equivalent? So if you think that the, stock market on an annualized basis is going to give you 7 or 8% net of fees, can you do better than that with your other investments? And what's the purpose of that? And so from an illiquidity standpoint, if you're buying the actual underlying real estate, then my initial kind of analysis is, can I beat 7 or 8% annualized net of all fees and expenses? And if I can, then I'm going to invest in that. If I can't, then why am I doing it?
Right.
Because I look at risk as not volatility. I mean, there's volatility. What's been going on in the stock market. Yeah, that's frustrating, but that's not. I don't look at that as risk, because I'm a long-term investor. I look at risk as not having access to my capital when I need it. And so if you have to sell something on the secondary market at a significant discount to get your capital out, that's risk to me. So anything that I'm doing that's illiquid, I know that number one, real estate's a little bit different than private equity, because private equity can go to zero. It's really unlikely for real estate to go to zero. You're not going to lose all your money in real estate. It might not be as high if you have to sell it in 2 years versus a 7-year hold. But ultimately, for me, I'm looking at it as when am I going to need this money? And if I don't need it, is it going to outperform the public market equivalent that I think I can do in the public stock market on an annualized basis? And I'm talking about nothing eccentric, not looking at, small cap biotech or something like that. I'm talking about just basic S&P 500 or the MSCI All Country World Index or something like that. That's my bellwether. So, but if you can get, go ahead.
Well, I was going to say, if I'm comparing it against, like for real estate, like multi-family syndications or build-to-rent syndications, they're typically call it like anywhere from 10 to 17, 18%. And so between that and farmland, I guess diversification is one thing. Like you want the diversification.
Yeah.
But I guess you want to stratify like how much you're investing and diversify according to your risk profile.
And I think farmland is going to be right in that 10 to 12% range if you just keep it as farmland. If you're able to monetize the water component of that, it could be over 20%.
Okay, got it. That's great. That's fantastic. And a steady, as you say, steady, call that 10 to 20% as well, right?
Yeah. 100%.
Yeah. Yeah.
Well, you think about what's going on. You have the underlying appreciation of the asset itself. So the ground is appreciating. You're usually getting a 4 to 6% return just off the crop returns themselves, and then you have the water asset on top of that. So plus all your ability to write off for taxes and depreciation.
Right, before I get to you, I had a question offline as well with you, Ryland, which is, farmers always say that they're not making any money. And that's true to some extent, but not really. So could you reconcile that with like investment in farmland?
Yeah. They're making money. They're making a lot of money. Farmers are, I mean, it. You start there, you're like, wow, that guy's driving around an $80,000 brand new pickup truck. I wonder where that money came from. That didn't come out of thin air. Farmers are pretty wealthy individuals. They work the ground. They're really hard workers, and to have a really amazing farm, they have to be good at what they're doing. The reason they say they don't make any money is because they reinvest almost all that money back into their farm itself as a new truck or improvements in systems or what have you, because they'd rather not pay taxes. So if they wanted to, there was that same farm that gentleman just bought for $8.3 million has about $600,000 in net cash flow a year. So I don't know what the IRR calculation is on that, but and that was a big number. I mean, $8.3 million is a lot of money. So, when you're sitting there trying to figure out, like, is this a good investment or not? That's a 7.2% cap rate, which is pretty dang good right now, regardless of how you look at that real estate.
Yeah. Ryan, do you want to ask a question?
Yeah. When you are engaging in looking at conservation easements and things like that, what type of properties do you look for that, and what are the different strategies that are top of mind?
Well, so conservation easements, I'm not in that world anymore. I used to run a nonprofit called the McKenzie River Trust, where I was actually placing farmland under conservation easements and forest land. A couple of things, though. Usually they have some kind of riparian connection to a river or an important river or stream. And there's also usually timberland or at threat, a piece of farmland that's at threat for development or potentially at threat for development. Now in Oregon, the land use laws are a little bit different, where it's not as big of an issue and there's not much value in conservation easements, primarily because the land use laws are so strict anyways that you can't develop farm and forest land until it comes within an urban growth area. So that's a little bit different, but for the vast majority of the country, like where I grew up in Virginia, you could take farmland and just build a strip mall on it. I felt like there was never any kind of land use regulations, and that's why we have problems with urban sprawl that we do. But if you do know, or if you think development's moving in a certain area, that's just a good hedge anyways. It gives you an opportunity to invest in that farmland, generate some revenue, and then if and when it is ready for development, then you get to make the decision: do I want to put a conservation easement on this piece of property and write off the taxes, or sell a conservation easement to a charitable nonprofit that's going to manage that easement in perpetuity and take some or all of the development rights off the property, or a combination thereof? So that's typically what you're looking at from a working farm, or where you have a working farm conservation easement. Is you can still maintain, you get those bundle of rights, and you get to decide: do you want to restrict those rights? Do you want to sell those rights? Do you want to develop the whole property to its maximum extent possible? That's why owning the real estate, you get to make those decisions. So, is that helpful?
I had a question.
Go ahead.
Thanks for that, Ryan. Did you have a follow-up?
Yeah, I just wondered what kind of returns when you factor in the conservation easement and all the other tax benefits would you see?
I mean, it's a case-by-case basis because it really depends on what is allowed on that particular piece of farm ground. But I mean, if you could, let's say you have, let's go back to the 100-acre example just because it's a nice round number, and let's say that you're allowed under the current land use regulations to subdivide that land into 25-acre lots or 52-acre lots. Let's do 52-acre lots. So you have 50 home sites potentially available, and are you going to develop that whole thing and turn that into a subdivision? Are you going to, restrict half of them and increase the minimum lot size to 5 acres to spread that around? Are you going to leave a green area and put the green area under a conservation easement and develop everything else? So the way a conservation easement is valued, though, is it's an appraisal process where the appraiser comes in and says, okay, what's this property worth if I develop the entire thing within the confines of the current land use regulations that are in place, or in the future, obviously land use regulations can change. And then what is the property worth with the restrictions in place that are being proposed in the conservation easement? And so that delta difference is looked at as a charitable gift to a nonprofit if you decided to donate that value. So if you say, I'm going to take half these lots off, that could be millions of dollars potentially, that is looked at as a charitable gift. Even though you're not giving them a physical dollar amount, you're giving something of value up. You can also sell that to a conservation organization, and they would take that on. So it just depends on what the restrictions are in place and how restrictive you want to make the property. Each time you give up one of if you look at all the property rights that you have with a given property as a bundle of sticks, how many of those sticks are you taking away for a future owner? And those permanent restrictions on that property have value. Each stick has a value, and once you determine that, whatever you decide to give up is looked at as either a charitable gift to that nonprofit, or they can sometimes pay you for that by writing grants. But you're still giving up value, and you're permanently restricting that property.
Ryland, I know we're coming up at the top of the hour. I just had one question left, which is kind of a two-parter. One part is, I heard on NPR yesterday that the Netherlands is able to grow like a pound of tomatoes using half a gallon of water versus like the rest of the world, we use like 28 gallons for that same pound of water. How much of the rest of the world is going to have to go the way that Netherlands is going, which is basically like indoor vertical farming?
Yeah, I mean, you start.
And then
yeah, go ahead.
And then I guess the question is like, how much is technology like that? Maybe not exactly like that, but like that, going to upend investments in farmland.
Well, great question, John, and that's something. I mean, I've seen a huge uptick in people they're interested in the water for the farmland initially, but now they're building aquaponic vertical farms on that farmland. So in hot houses for tomatoes. Yeah. So if you start thinking about, well, okay, if I just have my 100 acres, what's my efficiency of my system? This also goes back to that efficiency of conserving water, right? If you've got an aquaponic system where you don't have the evaporative losses that are coming from distribution, because now you're at 95 or 100% efficiency on the water uptake, because the water that's there is only being consumed by the plant itself. And you can vertically grow, so you can produce a lot more material in that structure than you could just on an acre of ground, for example. then think about the productivity and the returns on that piece of ground itself. So you're going to see more and more of that. It's just because number one, what you're talking about is you're talking about conserving the conservation of the water. You need less water to grow, and then you're producing more, so your output is significantly higher, and then therefore your return is higher. So you're going to see more and more of this efficiencies. Now, the infrastructure systems itself, there's some initial upfront cost to that, right? So it's going to take a little bit more time to get your return on that system. But if you're able to convert that once, piece of acre farmland, and now you can, the water right itself is still for irrigation. So whether you're growing it in vertical hothouses or you're growing it out of the soil on the ground, it's still irrigation and it's still in the same place of use. So the water right works. It's still valid. And then you might have some water left over to do some other things with it, to parlay that in more acres, to produce more, to sell that water to a higher value use. There's a lot of different options there. I know we're going to see more of that, though. We're going to have to.
The other part of my question is how much of, with climate change, like most of us are invested, whether it's 50%, 75%, or 90% in like the equity market.
Yeah.
How much of water conservation and kind of climate change should we factor in? And since our time horizon is like 5 years, maybe 10 years, your chart was showing 2050, which is 30 years away, but it's significant impact in 30 years.
Yeah.
How much should we factor that in our investments in our time horizon?
It's a great question. I mean, I don't know, if your investment horizon is only 5 years, then it's not nearly as much as it is if it's more of a longer term hold. But as that time horizon gets closer and closer, we're still having issues. We're already seeing managers start to factor that in as part of their due diligence into companies that they are investing in or in geographic areas they're investing in. And so I think we're going to continue to see more and more issues. Would I invest in real estate in Las Vegas right now? No, but I've got a good buddy from college that's his entire business is around Las Vegas real estate. And he's like, yeah, I don't see a problem here. We're still doing really well. So it just depends on, each person's kind of comfort with it. But for me, it's not just about dollars and cents. I'm just not going to use my dollars to support future growth in a desert community where there's no water, and what that does. You got to talk about not just the dollars and cents side of things, but also personally, what do you believe in? If you don't care and you just say, well, I'm going to make as much money as I can at all costs and I don't care, then yeah, maybe it doesn't factor into your overall strategy. But if you're looking at it from a sustainability kind of mentality while also getting really great returns, then I think you have to start to think about, what the future limitations are and what we each as individuals are doing that may be either contributing or promoting something that isn't sustainable.
It's great. Well, thanks for those last parting thoughts. That's a great point to end. And we're at the top of the hour. Thanks again, Ryland Moore, for all that you shared with regards to water and investing in water. If you have any questions about what you heard today, feel free to contact Ryland. This will be reposted in a couple of days. Again, Ryland, thank you very much for your time.
You're welcome.
And I hope the best for you in the future.
Thank you so much. Hope you all have a wonderful holiday season and enjoy your weekend.
Thanks, Ryland.
All right.
Take care.
Bye-bye.
Thanks, everyone. Bye-bye.